Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Mark Marex, Senior Director of Index Research and Development with Nasdaq Global Indexes, as well as Steve Schoffstall, Director of ETF Product Management at Sprott Asset Management. And we're here to discuss the key drivers of critical materials demand and how AI and geopolitics impact the space. It is great to have the both of you back with us. Welcome to Trade Talks. Steve, let's kick it off with you. Tell us some of the drivers that you see in the trends that are moving the momentum of critical materials and its demand.
Sure, and great to be back, Jill. When we look at the critical materials space, we generally think of those materials like lithium and copper and uranium that are really increasing the way that we move forward and the way that we're producing energy. So when we think about that, it really boils down to electricity is one key word. So if you look at the IEA's estimates, going out through 2050, there's an expected about 165% increase in electricity demand on a global basis. And when you think about just kind of the overarching themes of what's really driving that, first would be if we were to look at Eastern and developing countries, there really is a hunger for energy as they're expanding economies. I think mainly China and India driving a lot of that growth. As it relates to Western economies, it's things like AI and how that's integrating itself into our everyday lives, technological advancements just en masse. And then also the transition to cleaner energy is another space that we're seeing on a global scale that is really driving the overarching demand from critical materials. As you drill down into each of the materials, they all have their own kind of supply and demand drivers that are really driving things. But overarching, those are the themes that we see emerging.
Yes, Steve, certainly. I mean, we saw what happened with uranium when the announcement was made with 3 Mile Island and Microsoft leveraging that to power their data centers. The move was instantaneous. So certainly AI has to have an impact not only on uranium, but copper as well.
It does. So if you look at uranium, we'll start there. So you mentioned 3 Mile Island. That's where Microsoft was looking to offload or use 3 Mile Island to get that back up and running with Constellation Energy so that they can power their data centers that are driving AI. We saw something similar from Amazon with Talon Energy, also in Pennsylvania. Just last week, Meta actually came out and announced that they're actually putting out requests to work directly with people to help develop nuclear energy. The way that this really ties back to these large tech firms is, they're kind of stuck in this situation where they need to evolve, and as it relates to AI, and that is such an energy-intensive application, as not only do you have to power these complex algorithms and servers, you also have to keep everything cool. So they're caught in the need for large amounts of electricity, but at the same time, in their corporate mandates, they're also looking to have a net zero carbon impact. So they're increasingly turning to nuclear energy as a way to move a little bit away from wind and solar, which have intermittency problems. What you get with nuclear energy is that reliable baseload power that is always on, and that's why we're starting to see this change. As it relates to the overall AI landscape, and it's not only a nuclear energy story, it's very intensive as it relates to copper as well. Some of those data centers are actually wired with fiber optics that will, has its own trade-offs where it can help transmit data potentially a little faster than copper does. The downside to that is, and why we're starting to see some companies like NVIDIA focus on copper over fiber optics is because copper can run at a much higher temperature without the increased energy costs to cool that. So copper and nuclear energy are very much entwined as it relates to the AI sector.
Yeah, great to also be an electrician or in the HVAC business as well now too. Mark, it's interesting. It's just over 2 years now that we've really brought AI to the forefront because of ChatGPT and it becoming part of the consumer vernacular. And we've learned more about the technologies that AI can deliver. What's interesting is we're not talking about the stocks that have exposure to it, but how this story is moving across every sector. I just mentioned, let's look at the trades, right? It's everywhere that AI is making an impact. So how do you see that broadening out across the Nasdaq 100 index?
Yeah, Jill, I mean, it's a fascinating time to track something that is, I think, undoubtedly going to be a monumental technology in terms of transforming society, but also in terms of impacting markets, right? When you think back to the tech bubble in the late 90s, it didn't impact quite as many sectors, at least not initially, the way it's impacting, for example, industrials and utilities already. Today, utilities has become, this year sort of a pretty popular play, a way of sort of doing a backdoor AI play given the increasing power demand. And I think Steve's comments were completely right on. From what we've been seeing in terms of tracking, the suite of Nasdaq Sprott indexes that we have with exposure to various energy transition materials. The underlying story for power demand in the US, at least for the last couple of decades, it's been like this. Because the US has been growing, right? But we've been getting more efficient every single year. And now all of a sudden, you have the rise of electric vehicles, right? That's starting to gain momentum. And they use a lot of power. They also contribute to the grid, right? But they use a lot of electricity that used to be supplied purely by gasoline in the past. You've got the electrification heating going on, right? So as opposed to fossil fuels. Right. And then on top of that, you've got this new AI data center demand driver where, certain new data centers that are coming online, it's the equivalent in power demand of a small city of like 250,000 people. So now all of a sudden, instead of a flat line, you've got at least high single-digit growth of electricity demand in the US for the next decade, maybe decade plus, maybe 40% growth in electricity demands by 2030. A lot of it being driven by the trends we sort of already have known about in terms of energy transition, where you need a ton of lithium for batteries, you need some of these other metals to do energy storage and to do renewables construction and all that stuff. And now you've got this turbocharger from AI hitting you, right in the middle of that.
Yeah. Steve, what are the impact, not only of the US election, but geopolitics in general, because there are finite resources that everyone globally is competing for. So when you think about it, not only from how to invest in these types of areas to get exposure to that theme, how could geopolitics impact the underlying itself?
Yeah, that's a huge risk, right? So when you look at what China's done over the last 1 to 2 decades, they've really been getting close to countries in Africa. They're trying to get close to countries in South America that are producing large amounts of critical materials. So they're really ahead of the game from much of the world over the last 20 years. So everybody else is playing catch up, and kind of what that looks like now is we have a bit of a critical materials arms race that's shaping up. We have Western countries that are providing lots of incentives to onshore all aspects of the supply chain as it relates to critical materials. You're starting to see incentives not just in Canada, which is very much mining friendly, but even in the United States to start to mine some of that material here where we may not have done so much in the past. You're also seeing, as it relates more to what we're seeing from the threats of tariffs and things like that, China's actually restricting some of the, just announced last week that they're going to restrict gallium and some other materials that are getting shipped to the United States. We see Russia's countered and saying that they're not going to ship enriched uranium to the United States, which from the uranium standpoint is a huge deal because they're enriching about 40 to 45% of the global supply there. So what that's really doing is requiring these Western countries really to onshore and provide incentives from a government standpoint, not only to build the EVs here or build computer chips here for AI, but really going all the way through the supply chain from mine to refining to production. And we're really seeing that play out in Congress domestically when you start looking at a lot of the bills that came through the Biden administration, like the ADVANCE Act or the Inflation Reduction Act, actually had bipartisan support. And we think those are policies that'll stick around and potentially be more difficult for the Trump administration to overturn. When you start looking at the projects that those acts have actually helped stand up, there's been about 30 projects now under those various acts that have a price tag of $1 billion or more. 29 of those projects are in red states. So as the new administration comes in, politically, it makes it that much more difficult to start to roll back some of these actions.
Yeah. And Steve, when you think about what to know when it comes to investing in critical materials and then how we can get exposure as an investor, how can you access these opportunities?
Yeah, I think the first thing to realize is if you're relying on traditional market-based indexes, you're not going to have a whole lot of exposure. You might get it through some of the diversified miners. But what we provide in our ETFs is pure play exposure. And what we mean by that is we're generally targeting companies that have at least 50% of their revenue or assets tied to copper, for example. And that would be eligible to be in the copper index and the ETF. So our focus is on the upstream of the supply chain. When we worked with Nasdaq to develop the index methodologies for our lineup of ETFs, we purposefully left mainland China stocks out of the equation. One, there's just some human rights issues that could go on there. But secondly, we also think the growth is going to come largely from Western companies as governments are investing back into those domestic companies to really grow out supply. So we very much like the prognosis of miners. It does give you a bit of leverage to the underlying commodity. So when you're in periods of a longer term bull market, which we feel like we're in that for copper, we feel like we're in that for uranium, they give a little gas on the upside. Now on the downside, you could potentially have outsized gains relative to the spot commodity. But we think for investors, that's a good spot to target because they're likely underweight in their portfolio.
Yeah. And Mark, to wrap up here, you and I talk about derivative ways of looking at AI. Another area includes cybersecurity, right? Because when you think about this and the arms race for these limited resources, it also opens up the national security issue, and good actors, bad actors are leveraging the same type of emerging technologies like AI. But that also makes a great play into, with cybersecurity as well. And you're seeing that within the Nasdaq indexes that have exposure to it.
Yeah, that's right, Jill. I think one of the overarching, stories of the last couple of years and most likely the rest of this decade is going to be we're in a different regime, right? We're in a different market regime in terms of sort of underlying inflation trends. Steve mentioned tariffs, this major push in the US to do reshoring in other developed economies as well, in Europe and Japan, right? Reducing that exposure to China and other countries that, whether they're supplying raw materials or they're supplying something in the manufacturing supply chain of, computers or wireless technology or infrastructure, getting a handle around that, right? And reducing sort of sovereign risk to bad actors messing up your economy. And so, whether it's Taiwan Semi building fabs in the US or Intel building fabs in Germany or Israel or Japan, the progression of the world the last few years, the combination of COVID and the painful episodes there in terms of supply chain disruption, obviously with China shutting down wholesale, along with the geopolitical risks from the sort of axis of, I'm not going to say evil because that's an outdated term, but the axis of disrupting regimes that are out there. And I think you have to include China, Iran, Russia, and North Korea in that because they're major state sponsors of cybercrime. They control a lot of these really critical materials and minerals that go into, running a modern digital economy. And so, that is an underlying inflationary pressure as well that I think is very interesting from the perspective of doing metals investment and mining investment, because you just haven't had that type of inflationary consistent undercurrent setting itself up for multiple years like we do today. So I think it's a really, really interesting space from that macro geopolitical aspect as well.
Yeah, excellent points by the both of you. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.